Something is happening in the silver market that almost nobody is talking about. The price has ripped past $88 in just a few hours. China's largest silver recycler is paying $96 per ounce for scrapped silver. Not new bars, not investment grade, just recycled, melted down scrap. And COMEX? Vaults are emptying. Delivery notices are stacking up faster than ever. Trump has escalated tariffs, threatening the EU, creating uncertainty that sends capital flowing into safe haven assets. Industrial giants like Samsung are bypassing the open market entirely, securing mines directly. Everything is aligning at once. Supply, demand, geopolitics, and institutional behavior. What happens next could redefine silver's value and the market's trust in paper contracts. And no one outside this hidden network seems to be ready for it. Welcome to the channel, Boring Currency FX. If you haven't already, hit subscribe. Seriously, even if you're watching this from your living room on a quiet afternoon with your cup of tea, give it a click and tell me, where are you watching from today? The last 12 hours have been a war zone for precious metals, and silver is at the center of it. The physical market, the institutional market, and global demand are colliding in ways rarely seen before. Silver opened near $84, then was slammed down to $86 after a spike to $87. Panic seemed to grip the market. Weak hands were selling fast, but then it came back violently from $85 to $88 in what felt like minutes. The message was unmistakable. The physical buyers were in charge. Every time the paper market tried to push silver down, real money stepped in. The COMEX delivery data confirmed this shift. In February alone, 4,695 contracts were issued for physical delivery, equivalent to 23.475 million ounces of silver leaving the system. And the biggest players? Banks. HSBC, JP Morgan, and ADM were taking delivery not for speculation, but because they believed the metal would be worth more than cash. Every ounce removed from registered inventories reduced supply and increased pressure. January had already shown the system's fragility. In just 1 week, 33 million ounces were withdrawn physically from COMEX vaults, with JP Morgan responsible for 8.1 million ounces. Analysts had initially dismissed this as hype, but the data proved the drain was real and accelerating. Meanwhile, China's internal market added urgency. Their largest recycler was paying $96 per ounce for scrap, well above international spot prices. Combined with export restrictions due to silver's classification as a strategic material, this meant silver was being absorbed domestically at an extraordinary rate. Industrial buyers, solar manufacturers, and electronics companies were taking what they could, leaving less for global markets. This combination of COMEX vault drains, institutional accumulation, and domestic Chinese scarcity created a structural imbalance. The market was showing that paper contracts no longer controlled price. Physical supply did. And with Shanghai reopening after the Lunar New Year, analysts predicted a surge in bidding which could ripple across international markets. The silver-to-gold ratio added another layer of insight. Silver was outperforming gold on a percentage basis, compressing the ratio from 65 to 59 in a matter of weeks. Money was flowing into silver faster than into gold, signaling that the market was recognizing silver's undervaluation relative to its monetary and industrial role. Every signal pointed in the same direction. Silver was being accumulated physically and strategically, while paper markets tried and failed to contain it. Analysts concluded that the setup was exceptional, historic even. If these trends continued, silver could move toward $100 faster than conventional expectations. The forces in play were clear: physical scarcity, institutional accumulation, industrial demand, and geopolitical uncertainty. Silver was no longer just a secondary asset. It was transitioning into a primary strategic commodity, one that could challenge expectations and redefine market behavior. As the silver market reacted to physical scarcity, the role of major institutions became impossible to ignore. Analysts watching the COMEX futures data noticed a pattern emerging that was subtle yet profoundly significant. Delivery notices were rising, but not randomly. They were being executed by the largest banks in the world: JP Morgan, HSBC, and ADM. These were entities that rarely acted on a whim. When they demanded physical silver, it was a calculated move, signaling confidence that prices would rise and that holding metal, not paper contracts, was the only secure position. The COMEX system, long dominated by paper trading, was showing cracks. The open interest in March delivery contracts was enormous. Millions of ounces were tied up in positions that could at any moment be converted to physical delivery. Analysts ran the numbers and realized the consequences. If only a fraction, 10 to 20% of holders demanded delivery, registered inventory would be insufficient. The vaults could not sustain the withdrawals, and a structural short squeeze would become inevitable. Observers also noted the speed of the withdrawals. In January alone, JP Morgan issued delivery notices for 8.1 million ounces. almost the equivalent of Mexico's entire annual silver production. This was not a fluke. It was a demonstration of intent. Major institutions were moving to secure physical silver ahead of what they anticipated would be a dramatic price revaluation. And while the broader market remained fixated on day-to-day price fluctuations, these institutions were positioning themselves strategically, aware of the underlying supply crisis. Part of the complexity came from timing. Delivery notices often followed predictable patterns. London traders attempted to influence early trading sessions, attempting to create artificial downward pressure. Yet, these slams consistently failed. Physical buyers stepped in immediately. This created a unique dynamic where the paper market could not dictate price. The strength of physical accumulation was reshaping the mechanics of the market. It was no longer about speculation, it was about ownership of a finite resource. Furthermore, the combination of shrinking registered inventories and rising demand from institutional players created a feedback loop. Every ounce taken off the exchange reduced available supply, increasing urgency among remaining holders. Analysts noted that this loop had only strengthened since January. The drain from vaults accelerated, and the physical market increasingly dictated price action. The implication was clear: institutions were preparing for scenarios where paper contracts alone would be insufficient to meet demand. The sophistication of these moves cannot be overstated. Banks were not merely acting to profit from short-term swings, they were recognizing structural imbalance in the market. Each delivery notice, each physical purchase, was a strategic step toward positioning for a potential silver shortage. For young investors and entrepreneurs, understanding this distinction was crucial. The market was no longer responding to headlines or rumors. It was responding to real, tangible supply constraints. Analysts also highlighted the mathematical reality. With millions of ounces moving off the exchange and only a fraction of contract holders needing physical delivery, the market faced an asymmetric risk profile. A relatively small demand surge could trigger outsized price moves. Historical analogs reinforce this understanding. Prior squeezes in the silver market had shown that once physical supply constraints became widely recognized, prices adjusted violently. This knowledge informed institutional strategy. It gave banks a clear advantage over retail traders relying solely on paper contracts. Finally, Part 2 explored the implications of this shift for broader market participants. Traditional market assumptions, liquidity, stable delivery mechanisms, and the ability to access metal when needed were being challenged. Those unprepared for the structural shift risked exposure to sudden price spikes. Institutions, by contrast, were not just observing the market, they were actively shaping it, accumulating in ways that would benefit them as silver approached new highs. In conclusion, Part 2 emphasized a critical point. The COMEX market was no longer a neutral arena. Institutional actions were rewriting the rules. Delivery notices, vault drains, and strategic accumulation were creating conditions for a structural shortage. Analysts watching the numbers understood that paper trading could not contain the pressures building in the physical market. Silver was no longer simply a commodity, it was a strategic asset, with institutions leading the charge. The stage was set for dramatic price movements, and those who recognized these dynamics early would have a decisive advantage in the unfolding market scenario. While the physical and institutional dynamics in silver were unfolding, a separate but equally critical force was shaping the market: geopolitics. Analysts monitoring global trade and policy shifts recognized that silver was no longer isolated from broader economic pressures. Every action in Washington, Brussels, or Beijing had the potential to amplify the ongoing market scarcity. The first key catalyst was the escalating trade tension between the United States and the European Union. The Turnberry Agreement, intended to stabilize tariffs on exports to the U.S., had already been frozen twice, once due to political uncertainty and again because of legal challenges. Then, in a decisive move, former President Trump issued a social media statement threatening to raise tariffs even further, directly challenging the European legal framework. Analysts noted that such sudden escalation created immediate uncertainty. For markets, uncertainty equates to risk, and risk drives capital into safe haven assets. Gold responded first, climbing sharply, but silver followed, reflecting its unique combination of industrial demand and monetary perception. Simultaneously, China's internal policy reinforced scarcity pressures. By classifying silver as a strategic material, China effectively limited the global flow of refined silver. Only a small number of high-capacity companies could export, while domestic recyclers paid premiums far above international spot. This created a dual impact. Domestic demand in China absorbed available supply, while global markets faced a constricted pipeline. Analysts emphasized that this was not a temporary situation. Strategic classification and export restrictions were long-term structural constraints, which meant that silver scarcity could persist for months or even years, independent of daily price fluctuations. The combination of U.S. trade policy uncertainty and China's internal restrictions formed a potent geopolitical squeeze. It forced traders, investors, and institutions worldwide to reassess their exposure. Countries with large reserves, particularly in Europe and Asia, began to contemplate physical acquisition as a hedge against systemic risk. Unlike speculative trading, this was motivated by strategy, national security, and industrial continuity. The implications for silver prices were profound. Any sudden acceleration in global buying could meet limited supply head-on, producing extreme upward pressure. Particularly noteworthy was the timing of these geopolitical events relative to the physical market. The Shanghai Futures Exchange had been closed for the Lunar New Year. When trading resumed, analysts predicted an immediate repricing of silver as domestic buyers adjusted to the week's news. The combination of recycled metal priced above $95, restricted exports, and pent-up demand meant that Shanghai would not trade at parity with international spot. It would set a premium, dragging global prices higher. Observers also noted a subtle but critical connection between industrial demand and policy decisions. Companies like Samsung were already preemptively securing silver supply, bypassing futures markets entirely. Analysts interpreted these moves as a warning. If top-tier industrial users anticipated scarcity, they would act before markets could react. This created a cascading effect. As industrial buyers locked up supply, remaining physical silver became even scarcer, which, in turn, intensified the squeeze potential on COMEX and other exchanges. The interplay of geopolitics, trade policy, and industrial strategy revealed a market moving beyond conventional supply-demand models. It was becoming a scenario-driven environment, where policy decisions and strategic actions had immediate and measurable impacts on price dynamics. Analysts compared this to historical precedent. Major geopolitical shifts, combined with structural scarcity, often produced rapid repricing events. The difference in this cycle was that the signals were visible in real time through delivery notices, recycling premiums, and industrial contracts. The market was giving advanced warning, but only those observing the full picture could act. Finally, Part 3 highlighted the urgency of understanding these converging forces. Physical scarcity alone would have eventually pressured prices. Institutional positioning amplified the effect. But when combined with geopolitical catalysts, trade tensions, policy changes, and industrial hedging, the silver market was poised for an acceleration rarely seen in modern commodity markets. Analysts concluded that the stage was set for not merely incremental gains, but for a potentially historic spike in silver prices. In conclusion, Part 3 framed silver as a strategic asset influenced by more than traditional market mechanics. Physical scarcity, institutional accumulation, and rising industrial demand were intersecting with geopolitical tensions and trade policy uncertainty. The result was a market environment where every policy announcement, every tariff threat, and every industrial contract could have immediate price consequences. The emerging picture was clear. Silver was entering a period of structural and geopolitical pressure that could propel it toward $100, and possibly beyond, faster than most market participants anticipated. As the physical market, institutional positioning, and geopolitical forces converged, analysts began to see a rare alignment, one that historically signals major price movement. The combination of constrained supply, escalating industrial demand, and policy uncertainty created a perfect storm for silver. Each of the previous forces, China paying a premium for scrap, COMEX vaults draining, institutional accumulation, and trade war escalation, acted not independently, but as reinforcing levers. The result? A structural setup for silver to accelerate toward $100. On the supply side, physical silver availability was tightening at an unprecedented rate. The Shanghai Futures Exchange was poised to reopen after the Lunar New Year, and analysts anticipated that domestic Chinese buyers would aggressively bid on the market. The $96 per ounce paid for scrap by Chinese recyclers was not an anomaly. It was a signal of extraordinary domestic demand. Coupled with restrictions on exports, these actions meant that silver leaving China for international markets would be limited. The feedback loop was clear. Limited supply plus pent-up demand equals higher prices. Institutional positioning amplified this effect. Major banks like JP Morgan and HSBC had already taken delivery of millions of ounces from COMEX vaults. Analysts noted that these moves were deliberate hedges against both scarcity and volatility. Each withdrawal from registered inventories further strained the system. When March delivery notices approached, the potential for a structural squeeze became more than theoretical. It was imminent. Even a small percentage of holders demanding physical silver could trigger a supply shock. The geopolitical dimension added another layer of urgency. Trade tensions between the US and EU, along with the Supreme Court's tariff rulings and subsequent presidential statements, increased uncertainty. Markets, by nature, respond to perceived risk. In this scenario, risk flowed directly into precious metals. Gold climbed as the first refuge, but silver, tied closely to industrial and strategic demand, responded with sharper percentage moves. Analysts emphasized that silver's dual role as both industrial metal and monetary hedge made it uniquely sensitive to such pressures. Industrial demand, often overlooked in speculative discussions, played a decisive role. Companies like Samsung were securing silver directly from mines, bypassing exchanges and futures entirely. This indicated that top-tier industrial users no longer trusted the paper market to reliably supply metal. Analysts highlighted the significance. If the largest users were locking in supply, remaining physical silver would become increasingly scarce, intensifying the squeeze on COMEX and other exchanges. The structural imbalance was now visible not just in numbers, but in real-world business strategy. Putting these elements together, analysts projected clear scenarios. Silver breaking above $92 per ounce would signal the first confirmation of a new leg higher. Minimal resistance existed between $92 and $100 because the January rally had not built a stable trading base in that zone. Once breached, the path to $100 could unfold quickly. Beyond that, the long-term structural trends, continued supply deficits, industrial demand growth, and institutional accumulation could extend the rally even further. Risk, however, remained. Analysts were careful to note that potential events, such as a sudden resolution of trade disputes, a nuclear agreement with Iran, or regulatory changes at COMEX, could temporarily slow the pace. Yet, historical precedent suggested that even these interventions would only delay, not negate, the fundamental forces at play. The math was clear. Supply shortages, strategic accumulation, and industrial demand were persistent, structural pressures that could not be undone by short-term policy changes. The final takeaway was unequivocal. Silver's trajectory was no longer speculative, it was strategic. Analysts concluded that the market was entering a period of accelerated repricing, with the alignment of physical scarcity, institutional behavior, geopolitical uncertainty, and industrial demand creating conditions rarely seen in modern markets. The message to investors, traders, and strategic decision-makers was simple: recognize the structural pressures, understand the converging forces, and position accordingly. In closing, Part 4 emphasized that silver's move toward $100 was the result of a multidimensional shift. It was driven by physical market realities, reinforced by institutional accumulation, amplified by global geopolitical pressures, and accelerated by industrial strategy. Those who understood these dynamics could anticipate the market's next moves and potentially capitalize on a historic repricing event. Conversely, those who ignored the convergence risked being unprepared for a volatility spike unlike any seen in recent decades. Silver, analysts concluded, was no longer merely a commodity. It was a strategic asset, and the market's trajectory toward $100 was both inevitable and imminent.